Silver has a massive volatility. So it's a trading play, but it is not a long-term asset allocation play, according to me. I left Google in 2013 after spending 8 years over there. We actually built Cohesity. I stayed there for 9 years. It is now a $7 billion enterprise in data security. See, the problem is people are on either extremes. Either they have come from conservative surroundings and they feel that stock market is gambling. The other extreme is, I don't care, I will take as much risk, so let me do crypto trading, let me do FNO trading. Yeah. I don't think people truly understand, the role of leverage in life.
I think this is a problem that is also made by all the influencers, including me.
I would first go and ask how many influencers have gone ahead and bought their own homes. You should buy a house, but not before you have put some money in equity. If you're just starting a job, you should probably not buy it.
Hey guys, so in today's episode, I have a very interesting guest who is an expert in the world of finance and AI. So earlier he worked in Google and then he sold a couple of startups to different companies as well. And now he has basically started a new company called Auto Money, which actually personalizes investment planning and wealth journey for a lot of users. And in today's podcast, we spoke about some of his personal finance investments, how his asset allocation looks like, what are some changes that he did, what is his mistakes, some very interesting insights on personal finance. And also he uses a lot of AI in his app called Auto Money. So I wanted to understand how that works as well. So he spoke about some of the algorithms and how you can actually use it in your day-to-day life as well to build a personalized plan for you. So today is going to be very interesting. If you are interested in finance and AI and also about early financial hacks, then this is the podcast you need to watch. So first of all, Apurv, thanks a lot for coming here and giving your time. I know you're very busy and you're building your startup as well. And I know it's very difficult to build startups and a lot of time goes there. But again, thanks a lot for coming here and, spending some time to give some knowledge to the audience. Now, before we get into the entire podcast, I want to ask you this question because you've been a serial entrepreneur. You have done startups in the past. Can you give me a quick summary of what you did in the past with your startup that you built?
So, look, I left Google in 2013 after spending 8 years over there. The first startup was essentially that time virtual networks were coming in.
Okay.
The data centers, which today house all the AI, they were all physical routing and everything was getting virtualized. The monitoring part was not that great over there. So that's what we built. Observability for virtual network.
Okay. This was after the Google thing.
This was after Google. This was a company called Arkin.
Okay.
Which got acquired by VMware. Then the second startup, I joined hands with Mohit Aran. We actually built Cohesity. I stayed there for 9 years. It is now a $7 billion enterprise in data security.
Wow. So data centers and data security is where you did the first one. Beautiful. Now, I mean, you've been a part of two very good startups and I'm assuming both have done really well. And, whenever people do startups and they get a good exit, you get an influx of money that comes into the bank. Yeah. I want to understand your first feeling when you had a good influx of money in the bank. Did it scare you?
Well, yeah, the first time I saw some, larger bank balance, I was a little bit scared. I was like, okay, let me move it out of here. What if something happens to it?
Yeah.
But then I also started figuring out how to deploy it. I actually spoke with multiple wealth managers, looked for RIAs. Unfortunately, I did not have a pleasant experience that time. There was somebody who would cycle the money, say, put it in this alpha fund. 6 months later, they would say, this is not doing well. Let's move it here. I was not aware how much commission I am paying and all that.
Oh my God.
So that's something you should prepare for when this is happening.
Got it. So then from what I understand, by now you should be financially free, technically, right? You're completely financially free and all of that. But you have again come into the startup world from what I have read. It's called Auto Money. And you have again come into the startup world. So my question to you is, if you're financially free, why do a startup again? Why not just go to Goa and relax and chill?
See, everyone is built differently. I don't necessarily believe in retiring early. If I go to Goa and chill after 10 days in the resort, I'm like, okay, what am I doing?
Yeah.
Right? I don't think, humans were built to lie idle throughout their lives when they can do something productive.
Yeah.
Right? Yeah. So there is that. But there's a whole story on how Auto Money came to be. I can cover it now.
Please, I want to understand that.
So look, so the last few, in 23, I spent building a Cohesity's AI solution, Gaia. the more I worked with AI, the more the feeling I got that this is actually very powerful. And by that time, I think even ChatGPT had maybe just come or not come. I also invested in a small company in 22 that was doing AI, right? So I knew I wanted to do something with AI. In 23, the Cohesity acquisition merger was done. I spent 24 tinkering around, took a break, did the Goa thing.
Goa chill.
Did the Goa thing, got bored, came back, then tried for, I was actually building something for in education using AI. But then, many other things happened. So one thing I was sure is like AI is real. It is going to disrupt. I better be in the arena,
Correct.
not sitting on the sidelines and watching it.
Correct.
Right. The second thing that happened is I saw a lot of pain in India. There's a person I know, I will not name. That person basically lost a whole bunch of money in FNO to the extent that an NBFC in Calcutta filed a case against, took away their car. That transpired. A close relative of mine, this TV was, it's a structural bull market. The people who come and say it's a structural bull market at top of the market, right? Yeah. So that gentleman, he's a 70-year-old retired person. He ended up going to SBI, the bank he has trusted all his life. They sold him an NFO of mid-cap 150, momentum 50. Past returns were great, right? 6 months later, he is out of the market. Yeah. So, and, I have myself seen, how people were trying to cycle the money for commissions.
Yeah.
I'm sure most people in my generation have been also sold a ULIP without full disclosures of what is the commission, what is the loss, right? And then, my co-founder, Ankur, he and I were sitting at Manahan. This was like 24 end, right? Sometime like that. He is a US citizen. He also worked at Google. He returned in 22 to India. He was still working there. He told me that, he has got very good mutual funds from, the largest private bank in India. I said, do you know about, PFIC, right? So US citizens, if they invest in any passive instrument, like mutual funds or ETFs or REITs, they have to pay 37% tax on the notional gains at the end of the year.
Oh my God. Okay.
So fortunately, because I met him, I told him, and then he convinced me that Apurv, this is a market that is broken. There's all kinds of mis-selling happening. We should do something to fix it, right? So that's how we started Automoney.
Wow. So what is it? What does it do basically? If I can little digress because you put the story there, what is the main thing that is being solved there?
See, the main thing that is solved is lack of access, right, to good financial advice. So this is how people get financial advice today, right? They are either watching YouTube or going to Reddit.
Correct.
Or they are in the grip of people who are mis-selling them products for commission without appropriate disclosure.
Yes.
So, that's the problem that we wanted to solve. So what Auto does is it gives AI your full context. Okay. All your assets, asset allocation, your aspirations on what you want to do, and your future needs. Like it will actually, when you talk to Auto, it will do an interview with you. It will figure out your personal situation and actually add goals. Got it. Because most people don't think about goals, right? They don't want to. If you ask a 25-year-old, when will you get married? The answer is, I don't know, which is fair. But okay, maybe at the age of 30.
Yeah.
Or maybe would I want to buy a house by 35. So Auto does all of this, and then it figures out a good asset allocation for people.
Got it.
It also shows them. So Auto is basically your long-term personal CFO in your pocket. So you can talk to it. You can figure out, hey, how is your portfolio doing? What changes need to be made, right? And because it's not just AI trying to do reasoning on its own. It has this context. AI also has the market context. So what we have is a knowledge graph of the market. Okay, which mutual funds, who manages it, what stocks they hold, stock belongs to which industry. This is all encoded. So I can actually get data without hallucinations. And there are agents sitting behind. So once you have all this, you can pretty much do anything with Auto. You don't need to go and ask them. I had one user ask, how much am I spending on Swiggy? They found the answer, 28,500 per month. Right? That was very high for their income. The next time I met that user, that user had hired a cook. If you ask Auto how much life insurance I need, it will explain how much insurance.
Got it.
So that's the idea for Auto.
So you also touched upon this point of like good asset allocation or good portfolio allocation, which I have met a lot of people who keep stressing on this more than anything else, right? Now, if I had to compare this to a normal user today, let's say there is someone who's earning, let's say 50,000 rupees to 1 lakh rupees. How would you build an optimal portfolio for him, or what do you suggest would be an optimal portfolio for him?
But okay, let me give you the finance expert as a person advice, and then I'll give you the technology answer. Right?
Perfect.
So the simple rule of thumb is first take care of an emergency fund bucket.
Correct.
Right? Life is too uncertain. That is what derails people. 6 months of expenses is good enough, generally speaking. If you are in a very uncertain job, consulting, maybe increase that to 8 months.
Okay. And where do you park this? Because this is a question we get a lot.
Yeah, so about 2 months in fixed deposit and the residual in a arbitrage or a liquid fund, depending on your tax bracket. Right?
Okay.
So higher tax bracket, ARB is more tax efficient on a post-tax basis. On a lower income, it doesn't matter. You can put in a liquid fund. The second thing to do is actually also to take health insurance outside of employer. Because again, the job market is uncertain and health is one thing. The costs are so high that an accident there, something bad happens, you will end up in debt. I have known people in my office who have been in debt because of such situations. This is, some years ago. So you need to get those two buckets. And then you need to actually figure out, when would I need the money? So the answer changes dramatically for a 25-year versus a 30-year person versus a 35-year. See, what would a 25-year person should do? We already talked about it, that they should be planning for maybe some marriage expense, right? Now, so this is the thing. People understand volatility, but they don't really understand it until they have experienced it.
Correct.
Right? It's easy to say that I don't care, everything is in risk assets. What is difficult is when you need to withdraw the money, at that time you don't know what situation in the market is going to be. Imagine a person whose kid's college fee was due in 2008. That would have been terrible.
Yes.
So you need to safeguard against that risk. So you need to have a decent mix of debt and equity over a period. Right? So a 25-year-old who is planning for these two things, after filling the essential buckets, should probably go and look at, a mix of debt by which they can make the down payment for the house, and the rest can be in risk assets.
Correct.
Now, you don't always have to go the mutual fund route. If your employer is offering NPS, that also is a good product.
Correct.
Right? So you take care of these things. Now, let me give you the technical answer, right? Now, the exact answer depends on your income level, how far away your goals are, how much you want to spend. And this is where Auto comes in. If you go and tell Auto that, okay, I plan for this house, and it doesn't need to be exact. It will compute an optimal asset allocation for you.
Okay. But will that keep dynamically changing as and when my data points changes as well?
It changes.
Got it. Now, I have one question here, because today what is happening, most of the 25, 27-year-olds, if you tell them debt, or you tell them bonds, or you tell them FDs or arbitrage funds, they will say, what is wrong with you? We are 25, 27, we can take as many risk opportunities. This is the time to take risk. We cannot take it later. Do you think that is a good notion that is built in the 27-year-olds or 25 to 27 today?
So look, they're sort of right? And sort of not. So think about it. Do you want a car with only accelerators, or you also want some brakes? Okay, you think you only want accelerators because you want to go as fast as possible, but there can come a turn, right, where you might need the brakes.
Correct.
Right? You would eventually have to stop for a pit stop. Okay, you're going to need your brakes. So that is that sort of the brakes in the portfolio.
So that you don't affect the car.
Correct.
Yeah. Got it. And what do you think people are doing wrong today in this? Because you've seen a lot of mis-selling happening, and you've seen the, let's say, human psychology around people in different age groups. If you talk about the first salaried, second salaried age group, what do you think people are doing wrong here?
See, the problem is people are on either extremes. Either they have come from a conservative surroundings and they feel that stock market is gambling. I should put everything in safe assets.
Correct.
Bank is safe, gold is safe, right? Or FD. So they're not taking enough risk. The other extreme is, I don't care, I will take as much risk. So let me do crypto trading, let me do FNO trading, right? And both are wrong, right? Generally, the correct advice is to not take too much risk and not take this risk. You should find the right amount of risk that you should take.
Yeah.
The second thing that I have seen is with regards to, very conflicting views on house, right? Some people say that I think maybe the, social media has a role to play, that house is a trap. Don't buy a house at all. Some people would say, no, you should buy a house, right? And buy a house immediately. Right? I don't think people truly understand the role of leverage in life.
I think this is a problem that is also made by all the influencers, including me, right? There are people who say don't buy house and there are people who say buy house. Obviously, the audience is confused because there are valid points on both sides. It depends on you as an individual, how you are placed in life.
Right? So there are simple rules that you can follow, right? You should buy a house, but not before you have put some money in equity. So you should put some money in equity early because equity needs time to work. If you look 1 year return of Nifty 100, the volatility is around 18%, right? And the return is around 12%. I'm talking Nifty 100 historical, which means there is about a 15% chance that you will make like minus 6% in a year.
Correct.
Okay. That's how the standard deviation works. Now, if you stay invested for 9 years, the volatility reduces to 6%. Because the formula is, sigma by square root of n. So 9-10 years, there's a very good probability of you making money and beating FTs, right? So you should get some money in equity, let it start working for you. As your income also increases, you start adding some to debt bucket to be able to, either leverage when market shocks happen. See, if market falls, everyone says it's an opportunity. But where will you put the money from? If you are already 100% equity, where should you put the money? Right? So you collect that money. And at some age, you buy a house. A house has value, right? It first is, if you read Morgan Housel, he'll tell you there's a psychological safety aspect to it. The second thing is it actually allows you to take leverage, right? So you do the 20-30% down payment.
Correct.
The rest, you are actually borrowing from your future human capital, the money you would make in the future.
Correct.
And you can start, there's some factor of enjoyment also. But leverage is where you make money. So if somebody says real estate only appreciated 8%, okay, first of all, you add the rental, 2% in Bangalore, 3% in Mumbai. There is that component, but leverage magnifies it, right? So if you only spend 20% to buy the house, when the house appreciates, it becomes double, right? Or let's say it even goes up by 20%. On your 20 rupee investment, it's now 120. So you have made 100%.
Your IRR is actually good.
Yeah, you have made 100%.
Yeah.
20% appreciation is a house because you only put this much down.
Correct.
Is this much. So leverage is underestimated. People don't truly understand it. And this is one thing HNIs do very well. They understand leverage.
Yeah, this is actually, I want to ask you this, right? Because if you look at HNIs, you look at businessman, everyone says that you have to have some leverage on your portfolio. The quantum of leverage is debatable. But the rich guys or the smarter guys always have some portion of leverage. They're never full cash dunga or ghar dunga. Same thing on the opposite side. You talk about the retail investors. They are the most fearful when it comes to leverage, right? And they usually take the leverage also in a bad way. So what is your...
If somebody asks me, I think there are 2 loans which are good loans, okay, in India. I would say home loan, you should take it. Provided you're not getting the EMI trap.
Yeah.
Right?
What is a good...
30-35%
of your salary?
Of your take home salary. Your EMI should not exceed that.
Okay.
Because look, the other thing is life is not just about making money, it's also about enjoying it. Right? If you get in an EMI trap, then you are like, you have to watch every penny on where you are spending. What is the point of having that life? So that's a good rule. Now comes the leverage part, right? The only problem is when you take leverage that you can't afford. Right? Like taking a personal loan which is at a high interest. There are many people who today tell people, okay, take a loan against mutual funds and invest it. Why? Because they want to give you as much loan as possible. The math does not work. Okay, because they are giving it at 9.5. Given today's market, our capital market expectations are around 11%.
Yeah.
Right? If you invest today, I don't think even on a slightly longer term basis, you'll get more than 11% from it.
Correct.
Okay? But you're also servicing that debt. So your cash flow is also going in servicing that debt.
Correct.
So most people don't understand, the present value of future money. Yes, you will get that 11% later. But if you look in today's terms, plus the cash flow servicing, you're not making any. The second term is margin call. There's actually a movie called Margin Call. But a margin call can come where you have to pay back that loan. And what if at that time, the market has not gone up? because markets don't move in a straight line. The second loan that I tell people is sometimes okay to take is education loan, because again, these two, home loan and education loan, they are being used to build an asset,
Create more revenues.
correct? Because investing in yourself is the biggest thing you can do. But avoid signing up for random master classes.
Yeah. So one more question here. There is also another school of thought that says, don't buy a house. Rather, you take all that money, put in an equity fund. You will get more than your capital appreciation plus dividend income on. So the rental income, which is like dividend income on the rental property. That is what retail audience propagates. I've never seen any HNI propagate that. They are like, boss, I have balance on both sides. What is the wall that needs to be broken there? Myth, as you call it.
I would first go and ask how many influencers have gone ahead and bought their own homes. Okay. So you go and do some historical research. You don't need to read a whole bunch of articles. Go ask Gemini or ChatGPT and they will tell you.
Yeah.
Look, at some point, yes, but not everything is maths. If everything is maths, then you would not even buy a good shirt, because you can always get the same shirt in Zudio, right? So there is the enjoyment factor, there is this factor, there is the leverage factor on the house, and there is a safety. Once you have some assets which are safer, that allows you to take more risk.
No, this I've seen. I think a lot of guys, I think there are these Twitter guys who keep doing this, right? 1 crore invested in Nifty 2008 versus 1 crore invested in the house. Nobody's going to invest 1 crore in a house. It'll be 20 lakhs in the house. 80 lakhs would be dead. That 80 lakhs you can put in the equity. That math nobody will do, right? Everyone assumes you take full 1 crore, buy a house key in cash. And as you said, leverage is something that very few people understand. But if you play that leverage game, you win bigger. One more thing I want to talk about. We spoke about a good asset class. I want to talk about the other asset class, which is a car. Now, this again, there are two sides to the coin, right? One, today new proponents are saying, pura time Uber le lo, Ola le lo, don't get a car. The other side says, no, how many times will you go in Ola, Uber, buy a car? Again, a new guy who's just starting his job. These are some common questions people have. So how do I plan for this?
I think if you're just starting a job, you should probably not buy a car, right? Because it is not essential to your... See, look, car has become more of a utility, but think about it. If you can get power easily in your home, do you need to build a power generation unit in your house? So my view is, I don't think you should buy a car very early on in your career. But again, if you're living in US, for example, you have to buy a car.
You have no option.
Right? Yeah. Because, your commute is like 15 miles.
Yeah.
Every day. It works out cheaper. Right?
Yeah.
So at some point in time, yes, you want it. Think of it as, okay, it has some utility, but you also have to always trade off the math, the value of money against some utility of enjoyment also.
But not early in your career.
Not very early in your...
Do it with some bonus that you get or something.
Do it with some bonus, do it, okay, set a target, save specifically for it, then you take it.
Got it. Now, coming to you, what is the one mistake that you have done in your personal finance? Because obviously these things come from experience. I'm sure you have also had a bad experience somewhere in life, maybe when you were young. So what was something that you remember?
It's not a bad experience, but everything that I just told you about leverage on the house, I bought my first house cashed out by selling Google RSUs.
You bought your first house with cash?
Yes.
Full cash, no debt, nothing?
Full cash.
And you sold Google shares?
I sold Google shares.
What year? You don't mind me asking. My God.
So what happened is the house probably grew 3x and the Google stock is probably 10x from there.
Yeah.
Right? So I did not understand the role of leverage.
Yeah.
Of course, since then I have bought, more houses and they were all based on leverage.
Correct.
And leverage need not always be loan. Since I had assured cash flows, I took a builder plan. Whereas they complete. But that is also leverage.
Correct.
Because I am playing on appreciation of $100 by giving the builder $30. So there I've made XIRRs of north of 25% also.
But the first one was you shouldn't have.
First one I should not have done. And
maybe slowly eased into it kind of a thing.
I did not have that knowledge at that point in time. But of course, now I have gray hair. I've learned all these things over the years, putting time and effort into it and experience it. I hope more people can leverage that experience and not make the same mistakes.
So I have one more last question on this, right? Because you mentioned RSUs. I know that in India, this culture has now become very big. I know a lot of people who get RSUs from very big companies. Yeah. And most of them, I would say, are today confused about what to do with RSUs. Taxation I'll leave aside. Without the taxation part, they don't know what to do with this cash flow, right? They're good, rich people, right? There's nothing wrong with that. But if now you had to optimize it, like let's say today you're in that same situation that you were a few years ago, how would you optimize your Google or RSUs today?
So I have made a rule for myself, and different people can use different rules. So you have to make some rules that I will not let this exceed certain percentage of my portfolio.
The RSU?
Yes.
Yeah, because that is a fear that everything is in, let's say, Google, and it falls down.
So this has happened, right?
Yeah.
I have friends in Intel. The stock, their ESPP programs were running at $50-$60. The moment it fell to 20, you should see the psychological stress people were under, because actually I was in 2001, I was at Bell Labs in Murray Hill, New Jersey. A lot of people there had their 401k invested in Lucent because they believed that was the best company.
Yeah, my God.
Right? And their 401ks were massively down because Lucent was doing networking cables, and when the .com crash happened, it was a terrible, terrible disaster. So I have seen this multiple times. So the rule is to set it to a percentage of portfolio, maybe 20%. If you're super bullish about the company, maybe 25%.
But keep taking it.
But you have to take it out beyond that.
Okay.
See, investing is not just about maximization of returns. It is about maximization subject to the risk. I mean, this is why, you'll see fund managers, you'll see people like me advocate risk-adjusted returns.
Correct.
Right?
And how is your portfolio designed today? Like your personal portfolio? What does the allocation look like?
Broadly, I think 70% is risk assets, right? Equity. 15% is around debt. 10. So, and I'll clarify what is debt. 10% is real estate and 5% is precious metals. So when I say 70% equity, it's a mix of foreign equity, Indian equity, and some venture.
So well diversified.
It's diversified, right? Again, you have to look at, if you look at the correlation for Indian equity and foreign equity, it is negative. What that means is they're anti-correlated. When India doesn't do well, US will do well.
Yeah.
Right? They might do well together also for some period, but, look at the last 25 calendar year, US did pretty well.
Yeah.
Right? The debt portion is a mix of, some short-term debt, some long-term debt, some arbitrage, because as I said, arbitrage is more tax efficient, and some private credit. Real estate is a mix of physical and some REITs and InvITs. Right?
Okay.
And precious metals is gold. No silver. I sold out of silver. Maybe a little bit too early, but yes.
Yeah. But the risk-adjusted returns, as you call it, was a little volatile, right, over there? Or would that be okay?
Silver has a massive volatility.
Correct.
So among all the asset classes, so we, because we do asset allocation algorithm, HA3 has a table. So we track, expected returns, volatility, and the correlation matrix of all asset classes. And there we track NASDAQ, we track S&P 500, in Nifty 100, Nifty 150, Nifty small cap 250. Sorry, Nifty mid cap 150, Nifty small cap, gold, silver, real estate. We track all kind of assets over there. The most volatile is silver, right? So it's a trading play, but it is not a long-term asset allocation play, according to me.
What is this HA3 you mentioned? Is that something in your app?
HA3 is the algorithm which actually will compute an asset allocation for you. Right?
Can you explain?
Yeah, so it takes into input first from you, right? The context, right? So what are your needs? Like a house in 5 years, retire at this age, so on and so forth. Your income and expenses and how they might grow, right? And your assets and their breakdown, asset allocation, right? How much gold, silver, everything else you have, right? It then looks at the horizon on when these goals are. Then it also looks at this market expectations. And these keep getting revised, right? What is the volatility of each asset class? What is the expected return from each asset class? What is their correlation matrix? Because how will this move, that move? And then it also looks at, some fungibility of that goal, right? And it is pretty smart because it does not, I'll give you an example, right? My daughter is in 9th grade. She will probably go to college in 3.5 years, right? It does not model as it like one thing that, okay, you need like maybe 50 lakh. It models it as, so since medical 5 years, it models it as 5 withdrawals of 10 lakh equivalent today for her college fee. And then discounts that with the best risk adjusted return for that period.
Got it.
So 3.5 years, 4.5 years, right? Computes everything. Now, the problem with the traditional things is, they're, even if somebody tries to do goal-based investing, how many buckets will you manage? So what we do is we look at all of that. We do this asset allocation, we combine it, and then we tell the user this is how you should be invested. And then it's trusted.
So that is what HNI does, and that is something you guys have.
Okay, that's our proprietary algorithm. It sits as a tool accessible to AI, so that when you are chatting, it can do these things for you and tell you everything.
Got it. And does it also cover other stuff like taxes and all of that? Like, does your app also capture that?
Interesting that you mentioned that. You must have seen on our app.
I've seen the website and it shows all of that. So because taxes is something that many people, even though they are try to understand, they don't understand.
So I'll give you a simple example. There's this common video that goes around 15, 15, 15. What it means is if you put 15,000 SIP for 15 years and earn 15% interest, you will end up with 1 crore. Okay. So first of all, 15% is unrealistic. The math is wrong. It does not lead to 1 crore. I actually did a search and I found some websites which were actually showing 1 crore. But you do it correctly, it comes to around 92 lakhs. But this is your pre-tax return.
Pre-tax,
right? Now, you can't eat pre-tax returns. You can't consume pre-tax returns. Right? Only death and taxes are certain in life. So when you take out the taxes from it, you are left with something like 86.4 lakhs. But there is a way to save this. So the way to save this is, India has something called, India allows you every year a tax-free LTCG of 1.25 lakhs. Right? Now, think of a mutual fund only investor who is just buying the units one after the other and kept accumulating this, hoping to get 92 lakhs, even if they get the math right, but only end up with this. Right? Now, what they can do is, they can actually, from the second year onwards, they can sell a little bit, 1.25 lakhs worth of gains, and then reinvest it. Okay, so you're not interrupting compounding, but you're just being smart about tax gain harvesting.
So sell the units and rebuy those units.
Rebuy those units
very fast.
Very fast, right? Whenever the money comes in 2 days, you buy it. You keep doing this for, the intervening 13, 14 years, you'll end up with 2 lakhs more. You will end up with 88.4 lakhs.
Why do you think people are not doing this? Is it because we have a culture that just keep accumulating units, never touch it, never sell it?
I mean, that's the only reason I can think of, right? See, people who do stocks actually think about tax loss harvesting.
Correct.
Right? Correct. But there also I've seen most people try to square it off.
Yeah.
Which means come to zero.
Correct.
You should actually take it to 1.25 lakh. So you should actually sell your losers, but also sell enough winners so that you have 1 lakh of LTCG.
Clean money coming in.
Yes, clean money, tax free.
Yeah.
Right? Because you don't know what the government is going to do in the future with taxes.
Yeah.
But it's not going to get lower than 12.5.
And also, I think people don't do it because I feel it's also a little complicated for a common man to.
It is.
So, kabhi kharida, kabhi bechne ka, STCG lag gaya to. These are the problems.
No, so this is what happened. The genesis of this is I observed this. I was just, of course, right? You can't work for auto money and not learn finance.
Yeah.
So I was just having lunch with one of my employees and they did not know about it. So I said, why don't you build a feature? So now the app has a feature which will compute these things for you and show you opportunities for tax gain harvesting.
Tax gain harvesting.
Yes. And even tax loss harvesting. So you click a button, you can take the advice from Auto and execute it yourself. In case you're a mutual fund investor, you can also transact from Auto and actually sell this and do this tax gain harvesting.
Got it. And this is one more thing I wanted to ask you. Right now, obviously, this let's say AI has good amount of data, good amount of context, good amount of future visibility. Stocks is good. Let's say tax harvesting is good. Does it also give suggestions? Let's say I have a mutual fund basket, which usually people have 20, 30 baskets today, or even let's say 7, 8 basket. Does it give me suggestions on what to do? Like, should I keep it? Should I not keep it? Should I change it? Like an answer to the problem that is it even good or bad?
Yeah. So look, again, right? My quest for asset allocation started with trying to manage my own portfolio better.
Yeah.
Right. I had similar another quest for trying to figure out, how do I figure out what's a good fund and what is not? Okay, you can go to the top 3 websites in India and they all have different answers. So we actually spent enough time developing an algorithm for it. It's called the RAMP algorithm. So RAMP is an abbreviation. R is for risk, A is for alpha, M is for management, and P is for portfolio. Okay. So look, I always emphasize risk. Risk is very important, right? They are sort of the equivalent of, the brakes in your car, right? So a good measure is down capture ratio, right? How much does the fund fall when the benchmark falls? The alpha is how much excess return. If you're doing in an active fund and it is not giving you excess return, then why are you doing it at all? You might as well buy the index. But then there are 2 other things that we found were very significant for how a fund will do. Management is the most important. A fund may have short-term hiccups, but a good manager and a good process means that fund can recover. So we started figuring out, okay, how can we do this in a automated way, right? So we actually found many good signals.
Quality of a fund manager.
Quality of a fund manager. Okay. So we can actually figure out how much excess skill a fund manager has by, I'll give you the algorithm. You can actually run a regression against the Pharma-French 6-factor model.
Okay.
Pharma-French 5-factor plus momentum. And then you can see, are there excess returns due to skill in that linear regression that alpha will tell you. The other thing that statistically correlated, and because, we are engineers, right? We run everything through data science, is the number of analysts the fund house has, right? Because these are called the buy-side analysts. There are some fund houses with only 4 or 5.
Has a correlation?
It has a correlation because in the long term, it leads to better research.
So higher the better.
There is a statistical correlation.
There is a statistical correlation. Interesting.
The middle is not very clear, but the extremes are fairly clear. Extremes are fairly clear, right? The fourth is the portfolio. Portfolio is, we can look at the quality of the portfolio. That also seems to have an impact on long-term returns. You can look at the ROCE of their current holdings. You can look at debt to equity of their current holdings. This also carries a weight in the model. But look, the model is probabilistic, right? I'll give you certain examples. And I'm sorry if I name the funds. This is not a recommendation, right? But, the 3-year returns and 5-year returns for Quant FlexiCap looked very great. I think in N24 or early 25, the model said exit. And since then, the fund has underperformed. You can go and check. The model actually entered Quant FlexiCap in 25. So it actually said, go here. If at that time you look, the fund was not doing well. You look at the last 1-year returns, I think it's in the top 10 in FlexiCaps. But look, please understand, nobody has a crystal ball. If somebody tells you they have a crystal ball, they are lying to you. The second thing is, I will also, so to do that, I'll also give you a counterexample where we didn't catch it. So there's this fund, SBI Focus Fund. The reason I know is because it is in my portfolio. It was rated a poor fund, right? Sell. And it has been underperforming for a long time, since 2020 or something. But it's run by a very good fund manager, R. Srinivasan, who is the CIO of SBI Mutual Funds. Our algorithm didn't catch it. And then, suddenly in 2 months, the rating went up to the highest rating, consistent. Right? So I actually went back and checked what happened. He had Google in his portfolio, 3.5%. Google was stuck at $150 for a long time. There was this DOJ antitrust investigation. There's this, ChatGPT is taking the cake of AI.
Correct.
And suddenly in a few months, the equation changed.
Correct.
Right?
Narrative changed.
Gemini works better, right? The DOJ, Trump came and, they did not sort of break up the company. So that hangover went away. The stock doubled. And so you can see that very sharp curve. Now, am I changing the model to account for this? No, right? It is a probabilistic model and it's fine. That is just how it works.
Yeah. And do you believe in this term called FIRE? A lot of people talk about it.
So FIRE is actually 2 things, right? It's financial independence and retire early.
Yes. Everyone wants that.
I believe in the first. I don't believe in the second.
So you believe in get financially free first, independent, and then retire early you don't believe in. Why?
Well, so retire early is a personal choice, right? Once you get financially free, you can see, what being financially free is your assets are enough to sort of cover all your future needs.
So mentally, I'm free.
Mentally, you are free. What that gives you is it gives you control over time. See, time is the one quantity you can't go out and buy.
Correct. Sadly.
There are people trying longevity hacks and blah, blah, blah. But, not that yet. Now it's a personal choice how you spend the time. Okay, you want to go on a beach in Goa and surf all day? Great. You want to go work for that NGO for a cause that you always wanted? You want to do that startup? You want to maybe work partial time and, binge watch on Netflix? That's your choice. I personally don't believe in retire early.
Yeah. But you should get the FI part fast.
You should try to get, we have finite lives, right? The later years of our lives, you can't do much. So yes, even though you may live to be 85, 90, the quality of life severely degrades after 70, 75. You are not, even if you have the money, you won't be able to, go to Seychelles Island or Mauritius and this and that, right? So you should try to get financially free. But shooting for it to be very early financially free
is also not realistic.
You are putting undue pressure on yourself. And you're also then not enjoying your youth.
Yeah.
Right. So again, I advocate a balance. Right. Try to shoot for financial freedom by 45. I think that's a good metric. You have enough good years ahead to actually spend the time like you.
But I'll tell you one thing that is scaring a lot of people today with this FIRE concept also, which gets added to it, is this whole narrative of AI is now become scary. Right? This, I think, happened even in 2000s when the internet came in and then computers came in. Computers were only in James Bond movies. Then they became personal and now everyone uses it. But AI is in that era right now. Like sometimes the narrative becomes so scary that, I think my son, what will he do? Should I just buy some properties and keep it for him? But this narrative starts coming into the picture of AI is scary and it is going to be a very scary world. And every day you're getting up and saying so many jobs have gone. Claude releases one update, all IT companies are crashing. What is your take on this in the future? Because you're doing a lot of AI, like real AI, not the LLM based wrapper AI. You're doing the real AI. So where are you seeing this going right now?
Well, the answer is I'll give you some realism and then I'll give you some
me
hope,
as
right?
Even if it's bad, you give it to me straight.
AI is real.
Yeah.
Okay. Look, I have been through the internet era, right? I have been through the crypto era, right? Crypto is a fad.
Yeah.
I don't believe in crypto. Anybody can replicate their code and launch their coin. But AI is as real as internet. It is impacting lives. It is impacting jobs. It's just that when we sit in India, we don't see as much of it.
Okay.
Right? So if you are in software engineer, you are already worried that my job, AI can write code faster than me.
Correct.
At least the simple plumbing and this and that, it can do pretty fast. If you are in, let's say, a contact center, Bajaj Finance is using AI to call people and give them loans, right? I'm trying to give examples from India. But if you go to San Francisco and you stand right over there, you will see 30-40% of the cars are basically Waymo and Tesla taxis. So who's driving the car? It's AI. Right? No, it's a neural network. It's not a hand-coded thing, right? A hand-coded thing is where I put in rules. That would be an example of, something like HA3, which is a quant model, right? This is just trained on data. So that AI is real. The disruption is coming. And people need to prepare, their portfolios, right?
Yeah.
Their careers and even their children for it.
So which sector is will be so always there's winning sectors and losing sectors. Yeah. If I had to position towards on the winning side, where do you see AI will actually help XYZ sector in the future?
See, look, my fundamental view is that humans are very adaptable. We are probably the most adaptable race, right? We have survived a lot of technological shifts, right? Imagine when, power came. Before that, there was a lot of manual work. When cars came, New York used to have coaches, right? Horses entirely vanished, but people adapted. They became taxi drivers, right? Now taxis are getting automated. So my hope is that humans will adapt, right? That said, there are certain sectors where AI would be slow to disrupt. Okay. Medicine is one of them.
Okay.
Right? I mean, yes, I can sit in a driverless car, but I still don't want AI operating on me. Right? So that is one sector which will do well. That again, very heavy compliance sectors like our sector, right? We have AI, but the reason it's hard is because we have to make it not hallucinate.
Keep the guardrails.
If my AI generates some wrong recommendation, it's on me.
Yeah.
As per the RIA regulations, right? So, heavily regulated medicine, some of these are defensible sectors. I like healthcare as a sector.
Healthcare is safer. So you think AI will actually have an advantage to margins and companies becoming better?
Yeah, I mean, look, any company who adapts will do well. Any company who doesn't adapt and resists it will have a bad time. Right? Now, I don't always know which companies will be able to adapt to it. Right? Can Infosys, TCS turn the model around and make all their people into forward deployed AI engineers? Maybe they can.
Yeah.
We don't know.
And that would be a good way to, correct.
Right. So, but look, the human race has survived not on pessimism, but optimism. Right? There is a saying I like to, it's not mine, but, pessimists sound smart, optimists make money. Right? So have some optimism that we will figure something out. The kids are pretty smart. Give them the right skills, right? Not rote learning. They'll figure it out. I don't know what is the answer, but they'll figure it.
And one last question, because we're in the same field, right? Finance. I still feel like today it's day zero of AI in finance, right? We've not even scratched the lowest bottom of the surface, and already so many things are happening, right? Where do you see, what do you think in the future, if you had to project, would be very normal in the future, right? AI and finance has to become a merger. It's inevitable with the human, like every other sector. Finance has always been personal, right? Always they rather have someone, "Arey, wo acha aadmi hai," which I think in the future wo nahi hoga, because I think Gen Zs are already so GPT-ish that they trust it like their own, more than their parents, I would say. So where do you think, if you had to project in the future, what would be the amalgamation of AI, finance and human?
Look, I think pretty much my view is in 10 years or even in 5 years, everyone will have a personal finance assistant in their pocket.
Like it knows everything about
it. It knows everything about you, right? If you have excess cash sitting, you will just get by the way, our app does that.
Yeah.
You'll get a notification that, you have excess cash sitting. Should I move it into a liquid fund? You say yes, right? You get more comfortable. You set some guardrails and you let it do it for you.
Yeah.
Right? The other thing is, research analysis will become easier.
Yeah.
Right? Unfortunately, that means since everyone now has access to high quality research, Indian market may actually tend like US market.
Yeah.
Right? In the US market, 87% of fund managers do not outperform their benchmark.
Yeah.
In India, active funds are still able to beat, right? About, I would say, 80% of flexi cap funds beat their benchmark. And I was thinking it will take 10 years, 15 years for India to, get there.
Yeah.
It may happen much faster. Because if everyone can access the exact same research using this, then your edge becomes less.
Playing field is becoming...
Yeah. Like, today you had to know how to do DCF, right? You had to know what is a discount rate, how to do the terminal value and everything else. I think there's a Claude plugin that does it in, much faster than you can.
Yeah.
So I'm actually excited to give that a spin.
Yeah.
Right? But that's just how the world is evolving.
So future, I think all of us will have our own personal finance.
Yes, you should have you will have a personal finance assistant. Alpha will become harder. There would be fewer people who would be able to generate an alpha. But those who do will have to keep finding an AI-assisted edge.
Yeah, the scary thing is we'll slowly start moving towards passive index only then, because if most of them don't beat, then it goes like the US model where very few beat, and very few who beat also take huge charges there.
Correct. Yeah.
That is what happens in the US. Wow.
US has they innovate in financial products much faster.
Yeah.
They actually have funds which they call portable alpha. So today our mutual funds always have this market exposure, the beta, right? You can buy funds just for pure alpha, just pure manager skill, and you can assess whether the manager has any skill or not. I think India is going to get there. Right? So in our app, by the way, if you are investing in passive funds, so once we determine an asset allocation for you, if you want to be passive, you can actually do that. You can just say, let passive cover it. Right? I was hoping there are 5 more years where small cap funds, at least, the index will not do as well as active management. Now I don't know.
But crazy, yeah. This is very interesting because I get a good sense of things from 5 different angles. And yes, AI is definitely going to be there. As you said, it's real. I'm seeing how it's affecting in our work as well, even in the world of finance. There is a lot of changes happening. But again, man, thanks a lot for coming here and giving your time. I think there's a lot of knowledge in this podcast. So I think most people would have taken up some good stuff from here and some learnings as well. But again, anything else you want to say to the audience? One final thing about the future, about anything?
No, I don't have any prepared message for the audience. I will say, take a plunge into AI today. Learn it. Be nimble. Right? What you learned 4 years ago in college around, a chemical reaction may no longer be relevant. Right? And start adapting to these tools, right, including using auto to figure out.
Fair. So just adapt it, don't ignore it.
Yes, do not resist it, do not ignore it, adapt it. Right.
Again, thanks a lot for being on the podcast, and I really appreciate it. And for everyone else who wants to understand the platform that he's built, I will put all the links in the description and in the comment section below. Thank you.